Yes, ma'am, you are live.
Okay. Good evening, everyone, and I welcome you all to the fixed income webinar of Access Mutual Funds. So, the debt markets have been witnessing some very interesting times lately. In the last few months, markets have had rate hikes by RBI. We also had the Fed policy recently, and we have another RBI meeting coming up soon. However, high oil prices, inflation, and other macro factors seem to be the questions on most investors' minds today. And in order to address those, we have with us Mr. Devang Shah, co-head for fixed income at Access Mutual Fund. Over to you, Devang.
Thanks, Tanvi, and a very good evening to everyone. I hope everyone is doing fine. As Tanvi said, the background right. I think it's been quite interesting and challenging times for fixed income. Last 6 months, the landscape on bond deals and bond markets have massively gone through a change. We actually looked across. I think 6 months back, the situation was very, very different, where we were still talking about a slow, gradual increase in rate hikes. People were significantly confused. I think the themes which were run across then and December, January, as early as January 2022, just before the Ukraine-Russia war started, I think the theme which was spoken about is that we are still not out of COVID. There's a lot of uncertainty. And inflation is going to be a transient theme because of supply chain issues. Inflation will get sorted out. Growth is still going through a rough patch. So central bankers will actually be very, very slow and gradual in their rate hike process. Where in February, I think probably we got this Ukraine-Russia crisis. We actually saw significant spike in commodities, supply chain getting significantly impacted, oil shooting up to $140 per barrel. And this had changed the landscape for central banks. Central banks who were thinking about slow, gradual rate hikes panicked. And somewhere down the line, we have seen significant front loading of rate hikes, not only from Indian central banker, but across the globe to maintain financial stability. In India, if you look across in the last 6 months, April to now, it's actually less than 6 months, we have seen seesaw change in bond market yields and seesaw change in operative rate. Operative rate then on April 4th was 3/4. Just as a recap, I think in COVID, RBI had done massive changes and accommodative steps to ensure that growth cycle comes back on track in 2020, March 2020. And they continued with the accommodation for long, over 2 years, to ensure that the growth recovery comes back on track. We did huge liquidity infusion then. We did widening of the repo and reverse repo corridor. We did somewhere massive rate cuts and huge LTROs and liquidity infusion into the system. Time had come with this uncertainty on Ukraine, inflation spiraling up. Time had come to reverse those measures, and RBI started from April first week. That is the April 8th policy. They first introduced the SDF, narrowed the corridor between repo and reverse repo, which was a 40 basis surprise hike. Then they did a 40 basis May 4th hike. Then again in June a 50, and then probably again in August another 50. So all put together, the operative rate in the last 5 months has changed from 335 altogether to 540. It's been a 200 basis shift in the repo rate over 4 months, and which none of us anticipated. That led to a lot of volatility in the market. If you actually look across at the bond markets, the short end of the curve from 4th of April till now probably would have moved 1 to 3 year segment in lieu of these rate hikes would have moved by 100 to 200 basis across the curve. You've also looked at 10-year GSEC. 10-year GSEC in the same point of time has moved from 697% band to currently trading at around 735. So we have seen a 30-35 basis of sell-off in the long bond segment and approximately 150 to 200 basis of sell-off in the short end of the curve. I think, first of all, it is interesting to understand what is change and why this sudden significant increase in repo rates by RBI and other global central banks. Firstly, I think because of this Russia-Ukraine uncertainty, oil saw significant spike. We have also seen huge supply chain side issues, and which has made inflation a perennial issue and a persistent problem for some point of time. If you would have asked any capital market participant, any political people, I think when the war started, the general consensus was that within 2 months or 3 months, the war would end. Either we would see some kind of handshake, or we would see some kind, Ukraine probably would not be able to continue for long, or Russia might get bankrupt. But today we are 6 months into the war, and we have actually seen no significant easing in supply chain side cycle or commodities or oil specifically. Oil has remained massively above the comfort zone of $70 to $80, which is considered good for India. We have had for the first 6 months $95 to $105 as an average crude price. So that led to a massive change in the inflation projections, where we were expecting a significant cooling off of inflation because of supply chain opening up. We have actually seen supply chains getting significantly stretched, and inflation started to show increasing trends. Month on month, I think we hit 8%. And not only in India, this has been a global phenomenon now. We have heard about US inflation as one of the biggest concerns, which the Fed governor keeps on reiterating. And hence, we have not only seen Indian governor to front load the rate hikes, we have actually seen massive front loading across all central banks globally. Fed, ECB, Bank of England, you pick up a developed market or an emerging market central banker, we have actually seen massive front loading of rate hikes. They have all ensured to maintain financial stability, to ensure that we don't see a financial crisis in the form of currency depreciation or any other form of growth impact. The best option at this point of time was to front load the rate hikes, ensure that the accommodation is removed and inflation is got under control. The another important aspect is that if we somewhere down the line now project what is happening on the inflation front and the growth front and look at India macro, how does one should look at what would be the RBI monetary policy actions going ahead? I think the important aspect is to understand what kind of rate hikes are already priced in, what kind of rate hikes probably will happen in future, and what is the impact of that on bond markets. I just gave you a recap. The most important element is that if I look across at various growth and inflation and other macroeconomic variables, I think what is important for bond market and what determines the rate cycle from a macro perspective, if I look across or list some variables, I think it is very, very important to understand that growth, inflation, and the external sector are the three basic parameters which generally a central banker looks at while determining what action he should take on the interest rate cycle. Growth, to start with, which is a very, very important variable. I think in India, I covered the global growth cycle also, but in India specifically, we are witnessing a good growth cycle. We've actually seen strong consumption. We've actually seen a wealth impact getting created, and which has continued to lead strong demand. And it is not only strong demand from consumer side. We've also seen corporate savings getting translated into capex cycle. We have also seen a huge amount of spending from government, which has supported growth for the last 2 years in this entire downturn of COVID. What is also important to understand is that 2 years back, when we were just going through this unforeseen event of COVID, actually not 2 years, 2.5 years back, when we were going through this unforeseen COVID impact, the uncertainty in our minds was so high that we were worried about not only our lives, we were worried about our jobs, we were worried about how the continuity of our incomes. I think in the last 2.5 years, somewhere down the line, we have been able to manage and sail through all this well. Corporates have increased their savings. Even retail individuals like us, the income levels didn't change much. For some reasons, we didn't consume anything, so our actual savings increased. Plus, in the last 2.5 years, I think if you have invested just around COVID in any asset class, okay, in India or globally, I think you have made huge money because there was so much uncertainty. People just panicked. People sold off all kind of assets. You pick up gold, you pick up real estate, you pick up equity, you pick up debt. Everything was sold and was significantly undervalued. And if people invested in that, we also got a huge wealth impact. The returns might be different for different asset classes. But the point we're trying to put across is that where 2.5 years back, we were so worried about our certainty in life and certainty of our income, we have actually sailed through quite well. And somewhere down the line, the thought process is that this say increased savings and the wealth impact has led to strong demand even after COVID. And despite massive slowdown, despite cost push inflation across, we have seen significant increase in prices across all items. It is not only food, it is not only consumer durables. I think general supply chain getting stretched, we have started seeing an increase in prices across all asset class, across everything which we consume. But despite that, we have continued to have a strong demand pattern. So growth in India, I think, is strong at this moment, and hence RBI's sole mandate continues to remain to manage inflation. If you ask me personally, I think inflation is broadly the peak of the near-term inflation cycle is behind us. We have seen CPI in India also hovering around 7.5. We have seen one print at 8%, then it cooled off to 7. I think the next print would again be closer to 7.47 half levels. But second half of this financial year, which is October 22 to March 23, we believe that broadly inflation prints will be in the band of 5.5 to 6.5. So the average inflation for second half would be closer to 6% or below. The peak of inflation in near term is behind us. Structurally also, I think next year, due to these front loading of rate hikes, we might see some pullback on demand. We might see some bit of demand destruction, as well as opening up of the supply chains with China opening up slowly and gradually. I think the impact on inflation will continue to ease. Hence, our thought is that yes, RBI will continue with this front loading of rate hikes because they want to ensure that we are not significantly getting impacted either on global, because global central bankers are front loading, or they also want to ensure that inflation doesn't get out of control. So the central banker, specifically RBI, will continue with the front loading of rate hikes. But our thought is that after 6 quarters, 6 half, they would probably want to wait out for the data, incremental data, how the growth and inflation pans out, and then look at further rate hikes. So for us, how are we looking at this? We are looking at probably RBI to continue with a 50 basis hike in the September end policy that will take the operative rate from currently 540 to 590. The repo rate will touch 590. In December policy, again, we might see a 35 basis of increase in repo rate and take the operative rate to 6 quarter by December 22. Today, if you look across at a third element, which is very important, while RBI decides the rate hike cycle as well as the medium-term rate hike cycle or the terminal rate, it is the external sector. The external sector, if you ask me, INR has, and that's been a general question which is there running on investors' mind, that if Fed is hiking left, right, center, we have got 75 basis of increase in Fed rate just a couple of days back. And we have actually, we might see another 75 basis in November end and a 50 basis in December. So if Fed goes to 4.5 by December 22, do we see huge volatility in INR? Does that lead to a massive outflows from Indian bond markets and hence the impact again on rates? It's a good question, and I think so. Somewhere down the line, a large part of all this is broadly done. We have seen currency depreciation in the last 6 months or so. INR has moved from 74 to 80, $81. Personally, if you ask me, a little bit of more depreciation from here on also would not change our view massively on rates, as well as we don't see a 2013-14 kind of a repeat where we had huge FX outflows, because of which RBI had to increase rates by 200, 300 basis, and we saw an introduction of soft facility. Why we believe that we are not in 2014 and a repeat should not happen? Two, three things. One, relatively in 2014, we were one of the worst performing economies on growth front. Our external sector was very, very weak. Our reserves were less than 250 billion. Today, if you look across at our reserves, it is 550 billion. Relatively, Indian is the only economy which is actually growing at I'm keeping aside the Q1 growth numbers of 13%, but for a full year, we are the only economy which is growing at 7%. So when an investor is looking at investments across the world, I think India shines out from a relative growth perspective, a stable political mandate, and somewhere down the line, significant ease of business conditions. So FI market flows, probably even if we don't see inflows, we don't expect massive outflows. CAD to a certain extent has been taken care of with improvement in supply chain cycles, oil also easing from 140 now to sub 90. So our perspective is that yes, there can be some rupee depreciation. Rupee can touch marginally 80 to 83 levels, but even after that, a 10% or 11% depreciation from year to date, which has happened, currency has moved from 74 to 83. We don't see anywhere close to a 2014 scenario, and we don't expect RBI to do anything which will lead to massive increase in the short end of the curve, a repo rate increase of 200, 300 basis. I think I will assign a very, very, very small probability to it. So with that macro backdrop, where if I summarize, we are positive on growth. We believe inflation near-term peak is done. Inflation will fall, but inflation will continue to remain sticky because oil still hovers at 75 to $85. Or your supply chains opens up gradually. So I think inflation continues to remain sticky. And the third aspect is external sector is relatively very, very strong as compared to a 2014 scenario. What we advise, or what we believe so makes lot of sense for fixed income investors at this point of time, is the short end of the curve. The short end of the curve, if you actually look across, has massively sold off in the last 6 months. The 1 year to 4 year segment has massively sold off by around 200 basis, 2 percentage points increase in the last 6 months. The 1 year curve or the 1 year CDs or FDs were sub around 4.5, 5% band in April. The 2 year, 3 year corporate bonds were at 5 quarter, 5 half in April. Today, 1 year is above 7 quarter, around 7 quarter on CDs. Corporate bonds 2 year, 3 years are at 740 and 750, 55 levels. We have actually seen a massive sell off. The entire curve today, the markets as well as the repo curves are actually pricing in not only a September 50 basis rate hike, they are also probably pricing in a December 35 basis hike and the terminal rate of close to 6.5. Our belief is with Fed hiking aggressively, front loading the rate hikes, most part of capital markets pricing in and expecting Fed to hike till 4.5. RBI broadly done with 6.5 kind of terminal rate getting priced in across the curve from beyond 1 year. I think it makes a lot of sense for investors who have been out of fixed income markets for last 2 years because of depressed returns, because yields carry accrual was so low. I think fixed income markets didn't make any sense and the investments were very low in the last 2 years. I'm talking about since Jan 21. I think we have actually not seen massive inflows in these categories. Incrementally, when levels touch around 7.5, I think it makes a lot of sense for clients to start allocating money to fixed income portfolios again. The important criteria which investors should understand while selecting funds is, I think, couple of things. Okay, first is your investment horizon. What period of is my investment horizon? Am I looking at parking my money for 1 month? Am I looking at parking my money for 3 months, 1 year, 3 years, 10 years? We have different solutions as an industry depending on investment horizon. It is very, very important as an investor to match your investment horizon to actually get a good flavor and an experience while investing a debt mutual fund. If you are actually looking at short-term solutions, which are parking your money in for 3 months or up to 1 month, I think liquid funds makes a lot of sense. Okay, if you are broadly looking at an investment of up to 1 year and beyond 3 months, okay, I think money market funds, ultra short-term funds are the funds which investors should look at. If you are actually looking at beyond 1 year, okay, then the play comes around what part of the curve you should select. Today, where the curve is very, very flat, and what do I mean by that? in fixed income, it is very important to understand the steepness and the flatness of the curve. A year back or 6 months back, the curve in India was very, very steep. 1 year assets were getting traded at sub 5, 10-year assets were getting traded at 7%. Those are 200 basis spread, 2 percentage point spread between 1 and 10 year. The same has massively compressed because of this uncertain front loaded rate hikes, and which has actually led to the curve getting very, very compressed. The spread between 1 year and 10 year today, from a 200 basis peak in April, has moved to less than 30-40 basis. As I told you, 1 year CDs are at 7% and 10-year corporate bonds are at 7.5. So it's 40-50 basis versus a 200 basis on 4th of April. Entire COVID period, the 1 cross 10, the spread between 10-year and 1 year assets were 200 basis. At that point of time, the portfolio solutions will be different from what it is today. For investments beyond 1 year, when the curve is so flat, I think the short end of the curve makes a lot of sense. The 1 to 4 year segment is the choice which you should buy or start looking at investments at this point of time for 12 months to 36 months investment horizon. We at this point of time prefer either investing in short-term funds or roll down strategies of 2 year, 3 years, or target maturity funds of maturity 25, 26, 27, which we believe makes a lot of sense for investors in at carry of close to 7 quarter, 7.5. The same carry or YTM of these funds was significantly lower, like 5 quarter, 5.5 band in March 2022. We have actually seen a 200 basis increase in YTM over the last 6 months, and hence we believe that this makes a lot of sense for clients to start investing. I always give this corollary to our investors that as a retail client, when do we invest in fixed income? We generally say no to FDs when FD rates fall below 5%. And we go start investing and we go all in about 8%. Today we are close to 7.5. All these target maturity funds, roll down strategies, short-term funds are classic examples of substitutes to fixed deposits for retail conservative clients. Ballpark the current YTMs of these funds for the industry at large, and these are general month-end numbers which will come in some days. I think probably the YTMs of these funds would be closer to 7 quarter, 7.5 band. At 7 quarter, 7.5, our understanding is with the curve being so flat, okay, that additional duration for the buying the long bonds at this point of time is not compensating investors to buy long bonds. The short end of the curve makes a lot of sense when the curve is very, very flat and we are not expecting any rate cuts. The second question comes is that why only the short end of the space and why not buy long bonds? If the levels are so attractive, why not just go and buy long bonds? I believe so that the long bonds today at they are trading at 735. Okay, there's still inflation uncertainty. Inflation uncertainty on account of crude prices still continues hovers in our mind. We believe that the peak is behind us, but if we see something like the price caps getting introduced for Russian oil, and we see a massive blow up in oil again, this will lead to impact or some bit of hawkishness again from central bankers. At that point of time, I think duration assets to own currently at a very, very flat spread does not make sense. So inflation is sticky. We believe peak is behind us, but we are not going into a deflation kind of a mode where we will see massive correction in inflation. I think inflation will remain in the 5 handle for India for the near 12 to 18 months. Secondly, we also don't expect a bull cycle for rates. When do you invest in long duration products? When you believe rate cuts are going to come and we'll make capital gains because of fall in interest rates. Generally, the price of the bond increases and we make capital gains. We are not anticipating any rate cut cycle soon. We are now in the rate hike cycle, probably after 3-6 months, I think the rate hikes would be done. Post that, we will have a stable rate regime, and rate cuts are probably 12-18 month hence. So if we are not expecting any bull cycle on interest rates, nor we are expecting any, there is still uncertainty of inflation. I think the short-term space, which is the 1 to 4 year segment, is the most apt choice for clients on a risk-reward perspective and makes lot of sense at this moment. The last piece which I would like to cover is general questions on credit cycle and what is our view on this entire Fed hikes. Okay, uh, credit cycle is good, is very positive. If you personally ask me, I think in the last 2 years, corporates have repaired their balance sheets. We have seen massive liquidity getting created, capitals have been raised, solvency of corporates have improved, a large part of bank NPA mess has been cleansed. Demand today drivers continue to remain very strong. If you pick up the demand drivers today, I think high frequency indicators are seriously strong and show strong demand from end consumer. The thought process at this point is that growth, if you genuinely see, is a real growth positive cycle, which augurs very well for credit. The problem for credit is today is that spreads, absolute YTMs of credit papers in capital markets are very low. When I get a AAA paper at 7.5, if I buy a 2027 HDL today, I get it 7.5. If I buy a 3 year AAA PSU, I get it at 7.5 today. And a AA corporate probably would be trading at closer to 8%. A 50 basis spread is too low a spread, and hence we believe that it doesn't make sense for clients to shift or add credit funds at this point of time. It genuinely makes sense to stay invested in the AAA part of the curve, because not because the credit cycle looks bad, but because the credit spreads are too compressed and they don't give, from a risk reward perspective, an additional return to the client for holding on to that risk. So our thought process at this point of time is probably stay invested in the short end of the curve and buy AAA oriented funds. The last part is on account of the Fed. I think, yes, a lot spoken about. Fed has been aggressive than what the entire market was thinking. Last 2-3 days, again, we have seen some volatility in our bonds. We have also seen volatility in US treasuries. But personally, if you ask me, I think a large part of volatility, sell-off and bond deals is behind us. It is very difficult to catch the top. It is very difficult to catch the top or bottom of bond deals or any kind of markets. I believe 70-80% of sell-off and bond deals which should have happened has happened in the last 6 months. Everyone was caught unaware. We have seen huge rapid rate hikes. A large part of rate hikes would be behind us by now. Even though I also believe that incremental Fed hikes to the tune of where Fed takes the operative rate from currently 3% to 4.5 is broadly in prices. In fact, Fed also gave a dot plot, which is the guidance of their rate hikes, and they say that there has been no cuts till December 2023. So for the next 12-18 months, despite Fed talking about recession, despite Fed talking about that inflation will fall, they are of the thought process that they want to break the chain of inflation and ensure that inflation massively comes down. So that kind of hawkishness is getting priced in currency, in rates across the world, US treasuries, Indian treasuries. So our understanding is a large part of hawkishness of Fed as well as the Indian central banker is behind us. We have seen massive rate hikes from here on. Incrementally, it makes lot of sense for investors to start buying funds, to start looking at their investment horizon, to add up to 1 year assets for parking, and short-term funds, target maturity funds, and roll down for 1 to 4 year segment or investment horizon. So what I'll do, Tanvi, is probably stop here, and we'll try and address specific questions.
Sure, Devang. Yes, I like to leave the floor open for some Q&A. And in fact, Devang, let me start off with asking you the first question. We had a couple of questions when people registered for the session. That if considering all the factors that you said just now, which category or segment of funds do you think will add the most value to investors currently they want to invest right now?
So thanks, Tanvi. So see, what I had already covered this, but for repeat and advice to all the clients, I think our understanding is that the first and foremost important aspect while investing in a debt fixed income mutual fund, okay, it is important to understand the time horizon and invest accordingly. So if, as I suggested, if your investment horizon is less than 1 year, I think at this point of time, the apt choice is just buy the ultra short-term funds or money market categories. The difference in yields between a liquid fund and these categories is 75 to 100 odd basis. What do I mean by that in simple terms? A low duration category would be probably giving you a yield of around 675 versus a liquid fund category would be probably close to 6 quarter band. So there is a 50-75 basis of additional pickup in yield by investing in these funds. A large part of liquidity crisis, a large part of rate hikes is behind us. We are all now pricing in that RBI will be very, very hawkish. RBI will hike 50 basis, not only in September, but also 35 basis in December. We're all expecting this huge ample liquidity which we had for the last 2 years to vanish and probably get into a neutral or a negative liquidity. With all the hawkishness being built in prices, I think the money market and ultra short term category is very, very apt for investment up to 1 year horizon. For beyond 1 year,
Sure.
and investment, because a large part of tax efficiency for investor comes for staying invested in 3 years. So beyond 1 year and up to 3 years, I think the short-term corporate bond funds for active clients. And what do I mean by that? Investors who are okay with active fund management. Short-term bond funds makes a lot of sense at this point of time. As I told you, short-term funds are general substitutes of AAA PSU private kind of FDs, and investors are looking at such kind of investment horizon for 2 to 3 year horizon. I think short-term funds make a lot of sense. For passive investors who doesn't want to depend too much on the fund manager, who just wants to invest and sit and relax, I think target maturity and roll down funds of 2 to 3 year duration, which is 26, 27 maturity, target maturity funds or roll down funds makes a lot of sense.
Okay. Thanks, Devang. I have a question from Pooja here. She says that do floating rate instruments make sense given significant rate hikes might happen in future? So, and what is the kind of horizon one should keep if they want to invest floating rate funds?
See, I think floating rate funds is a very beautiful category, and thanks Pooja for this question. Floating rate funds makes a lot of sense in an uncertain environment. Okay, I think last year was a time frame when floating rate funds actually garnered a lot of AUM and were the talk on the town. What does a floating rate instrument means? Floating rate instrument means that where my coupon will get reset at a regular interval or a frequency with increase in rates. It is like our home loan. Like once your rates increases for the bank, for the central bank, your EMI increases or the reset in EMI happens. Why? Because the increase in rates gets passed on. So in a floating rate instrument also, the increase in coupon gets added to the carry of the bond and helps in getting additional carry with every increase in rate hike. So it is actually a hedge in a rising interest rate environment and works beautifully well for investors. I think now in this environment where a large part of rate hikes are behind us, now we have moved from 3 quarter 335 levels to we are talking about 6 quarter 6 half by December. Fed has moved from 0% to 4 half. A large part of the rate hikes are behind us. At this moment, I don't believe it makes sense for investors to invest in floating rate instruments. I think it is a fund which makes sense in an uncertain time to provide you a hedge against rising interest rates. A large part of rising interest rates, rate hikes, uncertainty on inflation is behind us. So incrementally at this point of time, I think investors in floating rate probably should move out and start looking at options as advised, which is short to medium term funds or target maturity funds with 2 to 4 year duration.
Okay. I have another question from Mahesh. He asks, what should be the ideal allocation to debt, considering that I also invest in PPF and fixed deposits? How much portion of my portfolio should I be investing into fixed income?
See, I think depends on the age group, depends on your goals, which helps you in determining what should be the allocation to fixed income. Because if it's a young age group, I think a higher allocation goes to a mix of equity and debt, as well as a part of the debt also probably you can take funds on the longer tenure, like short-term funds or medium-term funds makes a lot of sense. If you are also on time horizon and the goals, okay, if you require it for emergency and it's short term parking, okay, then probably you should look at liquid funds. If you're looking at medium term solutions, I think short term funds makes a lot of sense. What is the percentage of debt depends on your goals, your expected return, and your personal, I would say it's your age of investment also. Today, if you ask me at 7.5, 8%, what would I do? Okay. And equity at the levels what they are. I think fixed income as an asset class, people don't like too much because people generally treat it or use it like a substitute for FD. Our understanding is 7.5, 8%. You can never broadly go wrong in fixed income funds because these are the kind of returns. And if you don't take unnecessary too much of duration volatility at 7.5, 8% ballpark, it is a good time for investors to enter fixed income. Today, personally, I believe so. An allocation of 50-50 to equity debt makes a lot of sense. Among the debt allocation, a large part of my fixed income would be in these short-term funds or target maturity funds of 2026-27, or as I told you, our active short-term funds, because absolute carry of 7 quarter, 7 half for 2-3 years is the best solution, which I believe at this point of time. Allocation between PFs, I think those are mandatory, and allocation for an absolute yield also. I think PFs has lock-in. Here you are when you're looking at investments. I think in short-term funds and all, generally the time investment is up to 3 years. So they are different products as compared to FD. I think the point also which investor needs to keep into mind is the tax efficiency which an investor gets as against for if he's an investor for more than 3 years, the tax efficiency which an investor gets in a mutual fund is far much more higher as compared to an FD. So the tax bracket for an investor should also be considered while investing. So these are some of the, I would say, answers to his response. But at this moment, I think a larger allocation in the fixed income basket should be towards short to medium term funds if he has a 3 year plus investment horizon.
Okay. Devang, we have a question asking us, how does Access Mutual Fund differentiate its debt offering from others? And could you highlight on our fixed income process and risk management?
Thanks for the question. I think, mutual funds broadly, if I've been now working with mutual funds for last 17, 18 years. Okay. And what I understand is mutual funds, what the most important element is to manage risk. Axis Mutual Fund, what I like, and now I've been part of Axis Mutual Fund for more than 10 years. We were born in crisis. The Axis AMC started in 2009. So we have always been more risk managers than fund managers. In fact, in all our investment policies, and which give you a lot of flavor about how we run and manage the funds, the thought process is always about maintaining safety, maintaining a lot of liquidity, ensuring that we are competitive on returns, but with managing ensuring that the risks are managed well. So I always tell clients that be it the credit crisis, be it the interest rate volatility, we have not only seen now, we've seen in 2008-9, we've seen a big volatility in 13-14. Our risk ingrained policies have helped us to actually manage all the funds quite well. We believe in a lot of diversification, no concentrated bets, keep duration into a tight band, and somewhere down the line avoid huge volatilities. I think this has been our mantra, and which has actually helped us to probably deliver a decent performance over a long term track record. So our large duration funds have all been there for almost 8 to 10 years, and we have been able to manage a consistent, stable performance and returns for clients. So I think our risk ingrained policies are our strength and a differentiator point for Axis Mutual Fund.
Okay. We do have a lot of questions, but I'll just take this last one. That currently, how are the Axis Mutual Fund products placed in different buckets?
So I think Tanvi, it's a good question, and it is important for retail clients at large. Okay, I think SEBI has done a beautiful job of categorizing funds as per the investment mandates. I think the investment horizon, the risk goal, is the most important aspect to experience a good return while investing in fixed income funds. If your investment horizon is small or lesser, then please use parking solutions. Axis Mutual Fund has funds in the parking categories, which is Axis Liquid, Axis Overnight Fund, which are parking solutions up to 3 months, and Axis Money Market and Ultra Short Term Fund for investment horizons beyond 3 months to 12 months. If the investment horizon is longer and people are looking at solutions for beyond 12 months and investment horizon up to 3-4 years, I think short term corporate debt strategies are very, very good for conservative clients, and credit and medium term categories are very, very good for clients who want a flavor of a corporate FD. So slightly higher returns with obviously some added risks on account of allocations to AA, higher duration volatility. So I think SEBI does the good mandate, and as a mutual fund, I think broadly the basket of funds is very similar. You have these short corporate debt banking PSU funds, which are all probably replicating each other. And if you personally ask me, those are funds which are good for conservative clients who want quality bias portfolios or looking for 2 year, 3 year investment horizons. The second thing is people who want that slight additional return and who are okay with taking some risk, who understands credit volatility, who understands credit risks. I think credit risk and medium term funds give you those flavors. So these are the products which broadly mutual funds have at large. And then you have, these are all the active managed funds. And then you have a certain sets of target maturity funds, okay, and which are pure passive strategies, which are used only as a substitute for FD's better tax efficient solutions. I think those in our basket, we have the 25, 26, 27 target maturity funds, out of which 2 are index funds and 1 is the ETF. So broadly, like every other mutual fund, Axis Mutual Fund also has funds in each of these categories. SEBI has done, and I reiterate that investment horizon is the most important element which you should choose before allocating to fixed income funds, because it not only gives you a good experience while staying invested in the fund, it also helps you to generate returns and meet your goals. So this is the broad breadth of funds at Axis.
Great. Well, thank you so much, Devang, for those wonderful insights. And I would have loved to chat more with you. In the interest of time, I would like to close the session and request the audience to know more about our fixed income fund. Please visit our website, and hopefully we'll have another session with Devang coming soon. Yes. Thank you so much, Devang.
Thank you, everyone. Thanks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.